but some are just small family businesses. Can you explain it from a layman's eye?
Too much passive income, it actually hurts your small business tax rate.
Because not everybody understands the language.
Sorry.
Can you tell it in one sentence?
Our job to find the path within all the acts to try and get the client further ahead. That's our job.
In this podcast, I had my close friend Laura Quinn, who deals with ultra high net worth clients. Laura talked about structuring IFAs. She talked about how a policy can be structured, premium can be borrowed back, and all those complicated structures to make it work for you. Hi, welcome to Simple Wealth Wisdom Podcast. I'm your host, Gakhar. Each week, I bring simple financial security ideas for successful business owners and professionals like you to help you build and maintain your lifestyle and legacy. As an insurance and investment advisor, I work with business owners and self-employed professionals like you. I see a lot of you are always looking for tax advice, accounting advice, legal advice, estate planning advice, and investments advice. When I work with you all, I always work with a team of lawyers, accountants, estate planners, and investment advisors. As your trusted advisor, I want to make sure that I bring the best to you. You usually hear everything from me, but now I feel through this podcast, I can bring all those people here who are my support system, and you can hear directly from them. This is the reason I started this podcast, where business owners and self-employed professionals like you can always go and get the ideas and answers to their questions regarding how they can protect and grow their wealth in the most tax-efficient manner. Again, being an insurance and investment advisor, and very specifically working with business owners and self-employed professionals, I feel each guest will bring a lot of value to you all. And today, I have Laura Quinn from Vision Financial Partners Inc. as my guest. She's the president of Vision Financial Partners. I'm so excited to have her. She's got loads of experience in the industry, and she's talking to me directly here to answer all the questions of the viewer. Thank you, Laura, for coming here.
My pleasure, Sim.
And welcome here. Laura, it gives me so much confidence telling you that when you are working with me, my clients are getting a lot more than what they're getting only from working with me alone. You're in the background, and that tells everyone that I'm working with a team of professionals. Now, most of the time, you are talking to the advisors, and now you're talking directly to my clients because I'm going to be asking you the questions which my clients ask me.
Okay.
Whatever they have in their mind. So most of the questions are going to be coming directly from them, but I want you to answer it for them. So thank you so much for giving this opportunity. My questions are going to be very general, and I want everyone to understand in an easy layman's language.
I will try.
Yes, and most of the questions are going to be for business owners and self-employed professionals because, I work with them and I deal with those questions every day. And now I have somebody who's got 30 years of experience, who's married to an accountant.
That's true.
And has the whole tax background behind you. So let me hear it from you, Laura. My first question is about public companies and private companies. There are public companies and there are private companies. What type of corporately owned life insurance are there for public companies and private companies, and why? How can they hold insurance in there? So, some people have restaurants, some people have businesses, some are public companies, but some are just small family businesses. Can you explain it from a layman's eye for them to understand?
Yes, I can. So in public companies, generally they're much larger. There's the whole shareholder class, and then there's the board of directors. And in that scenario, generally only term insurance is used for that. And term insurance being insurance that's just for a term of time. It's used for key man protection. So there's a CEO or a specific person that is like so integral to the business that they have to have replacement costs, so to speak, if something happens to them. And that's generally for public companies, all that is done. There's no investment components, nothing along those lines, just because with a major corporation, it would have to pass through so many levels of approval, so it just doesn't happen.
Right.
And I've worked with many public companies, and generally it's just not done. Private companies, though, a privately held corporation has so much more ability to use things governed under the Insurance Act to do estate planning, to do retirement planning, shelter growth. Like in private companies, usually just because the profit levels are lower than a huge public company, right?
Of course.
In private companies, if you have too much passive income, it actually hurts your small business tax rate. So we tend to use the Insurance Act to shelter passive monies to try and make sure that there's no income generated from passive income to change the tax rate within a small corporation. So there's lots of planning that can be done for the smaller corporations or professional corporations. There's so much opportunity. We can do term insurance too for buy-sells if that's required, but generally no. We tend to do a lot more advanced planning with the smaller corporations.
Permanent, yeah. Just to make it a little more clear to the viewers, because not everybody understands the language.
Sorry.
Can you tell it in one sentence, or maybe in the few sentences, the difference between a public company and private company?
So private companies are just held within generally a family or a couple of families, whereas a public company is traded on a stock exchange. So it's just a totally different animal. So that's basically it. Basically, families own privately held corporations. They can be very profitable, very large, but it's generally kept within the family.
Yeah, and most of the small businesses are privately held companies,
Yes,
and
100%.
there could be multiple partners in the company, but again, all those shareholders in the corporation, and then that is where it comes that insurance can be placed. So I'm going to come to Mike insurance question. That is my favorite question, right? Yes. You know, whether it's a professional or it's a business owner, they're making money. That's what their business is, their baby.
That's what they're doing.
I always call it.
Yeah.
More wealth, more money, more tax.
Yeah.
And everyone is looking for a compliant way to save tax. And now wearing your insurance hat, tax hat, all those things that you are an expert, how do you think insurance should be positioned here?
That's a good question. There's kind of three acts that we generally work with. It's the Income Tax Act, the Bank Act, and the Insurance Act. They all apply, they all have different rules. So it's our job to find the path within all the acts to try and get the client further ahead. That's our job, right?
Right.
It's just to make sure that we lift the family up,
Yeah.
right, from where they are. And that sometimes involves reorganizations or asset movement or what have you. So generally though, from an insurance perspective, it goes back to everything under the Insurance Act grows tax sheltered.
Right.
And that's different than the Bank Act. Stuff is taxable in the Bank Act.
Can you give an example of that?
Like a GIC.
Yeah.
So a GIC at the bank, in a corporation or even personally held, it's at your marginal tax rate.
Yeah.
So, and unfortunately 100% of your GIC interest is 100% taxable, and you always have to take a breath when you see a lot of interest income. Interest income has the worst tax treatment.
Yeah.
Whereas if we bought a GIC or did a fixed income investment within an insurance company, that growth is sheltered. It doesn't throw off a T5 is what happens.
Are you talking about if you do it in the insurance policy, the investment?
Yeah, in an insurance policy, yes.
Yeah.
Okay. So, or it could be in a GIC within an insurance policy. But if we can keep it in an insurance policy, we get the tax lift, right? Because we're not paying the tax.
You're not paying the tax.
So our job is to mechanically look at it and say, yes, there is a cost for the insurance,
Mm-hmm.
but generally it's a lot less than the interest that's being paid, right? Or the income tax on the interest that's being paid. So,
Right.
we work through the whole thing just to see if we did this strategy, how does it lift the client? If it works, it works. If it doesn't, it doesn't. It's very, very black and white, right? It's not.
And that's the advantage of having a specialist like you who can actually look into everything and do the full comparison, right?
Yes, and then the interesting thing about that is like that's all I do.
That's all you do.
right? So it's
So
kind of it.
let's work with an example.
Okay.
Let's say you and me are business partners.
Okay.
All right. We run a restaurant.
Okay.
We are 50-50 and we've been running it for many years. Let's say that. And now we're no longer wanting to run this business together.
Like I'm
Okay.
retiring, or we hate each other, or something like that. Like, what's
I
happening?
want to retire
Okay.
and we don't get along anymore.
Okay, that can
Something
happen.
has changed, okay?
Okay,
Something has changed.
Something's changed.
What happens to the policies that we bought into the corporation? We bought the policies thinking that, okay, we're going to be there forever. Things changed.
Yeah, and that's business. Things do change. Some years companies are profitable, some years they're not, or there's a change within the family, or a partner dies, or whatever it is, things change, right?
Right.
So everything that is built has to be looked at with that sort of perspective. Like,
Yeah.
how can I get the client out if something happens, right? So generally, it's a great question. A lot of times when we buy insurance, we try not to buy it in the operating company,
Mm-hmm.
only as a function of the fact that a lot of times with entrepreneurs, operating companies are sold,
Yes.
right? That's generally the goal. I'd say about half the time it's the goal.
Yeah.
A lot of times they want to pass it to their kids.
Yeah.
Doesn't always happen, right? Or there's a problem within the relationships of the business partners, right? So if it's in the operating company, then we have to look to see if we still want to retain the policy. Like if I'm retiring, who's retiring? You're retiring.
I'm retired.
So you're retiring. So if you have a policy inside of the operating company, is it a taxable disposition for me to move it?
Mm-hmm.
As the advisor, not as your business partner, but what's the taxation to move it? If there's not any taxation
Mm-hmm.
for a bunch of technical reasons, then we'd probably put it into a holding company.
Okay.
It would also depend if we as partners.
So, sorry. Did you say that we'll move it from operating company
Yeah, you
to
can move it to the operating company to the holding company as long as it's not a taxable event.
Okay.
That's generally like why we originally built these. We like to have them in the holding companies because the goal is generally for somebody to retire.
Yeah.
Right, but if it's in the operating company, we see can we move it? Is the first thing. Can we
Okay.
move it? Do I, as the retaining business partner, want to keep it?
Okay.
So would I pay you for it? Would it be part of the ownership of the company, the value, to buy you out if you wanted to walk away?
Okay.
Or if not, like if it's a taxable event and to move it, then we may have to what's called butterfly the rest of the assets into a different company.
Mm-hmm.
Because if you change ownership, it is considered to be what's known as a disposition. So if it's a hugely taxable event, then we may leave it in that company, and then I, as the person who's retaining everything else, takes the rest of the assets into a new company that I would own.
Okay. So I'm going to go back to the question
Sure.
that you and me are partners in a restaurant, 50-50. I'm retiring and or I don't want to work with you anymore, and I'm saying, okay, bye-bye, Laura.
Yeah.
Now, we've got a policy, permanent policy. We had been paying good premiums, let's say $50,000 or $20,000 a year for that. Many years. And now I'm leaving that business. The policy we bought was in an operating company. We didn't buy it in a holding company. Corporation was the payer, corporation was the beneficiary, and corporation was the owner of the policy.
Yeah, so it's an asset on the corporation's books.
Right.
Right. So then if you were going to leave and you wanted me to buy you out, that would just go into the total fair market value of the corporation.
Okay.
Right? So say the company is worth, say that policy is worth $200,000 of cash.
Right.
And the company is worth $1 million. So you want me to buy you out, I have to give you $500,000
Right.
for your half.
Right.
So do I send that policy to you as payment? Is that 200,000? You know what I mean? So
Yeah.
do I send that out plus another 300,000? Or if that's a nightmare mathematically,
Right.
then I might take a loan and just pay you $500,000. There's a whole bunch of different ways to do it, and it really depends on what's the goal of everybody. Like, do you want to have? Maybe you're no longer insurable.
Mm-hmm.
Maybe you want this for estate planning for your children.
Mm-hmm.
So you're like, I need this policy because I can't get another one. Right. So the conversation, it is different for every single client. So it's hard for me to give you a straight one answer because there's not a straight one answer. It's a different scenario every time, but it does show up as an asset on the books. And then there's a bigger discussion, which involves all of us stepping in, the CPA, and we'll all step in and be like, okay, so what are we trying to accomplish here?
Yeah.
Right? It's a different conversation too if you're just retiring or we're not talking.
Yeah, it's totally.
Yeah.
And you know what? A lot of time people are scared to get into the insurance, thinking about that. What if we don't work together anymore? So there are the ways that this policy can be taken.
Sure,
That's the reason I wanted everyone to know that it's good to have protection. And there are the ways you can move it from opco to holdco. I mean, if you, as long as you understand, and if there's no tax implication, there's no transfer can be done smoothly, or they can move it even personally if they're not insurable anyway. Can they move it to their personal?
Yeah, sure. I mean, it depends on what's the buyout of the whole experience,
Yeah,
right?
yeah.
Because you're taking a corporate asset and you're taking it personally.
Personally.
Is it how's that happening? Are we
Yeah.
redeeming shares? Is it what's happening? But
Yeah.
there's lots of ways to move it with you.
Yeah.
So, and a lot of times, the act changed in 2017. So now, it used to be in the olden days, we could have a policy on the books for 13, 14 years before there was a taxable implication. Since they changed the act in 2017, it's a much shorter time frame. We have about 7 years,
Mm-hmm.
but we track it. So, and then we keep checking to see is it taxable yet? And then we keep meeting with the clients. We meet with the clients every year, right?
Yeah.
So, or at least. So it's like, how are things going?
Yeah.
Like, do we want to move it? Because sometimes corporations start off as a smaller event, but after 5 years, it becomes a much bigger company. And now there's holding companies. There's all these different things that we have to do. So
Right.
we just keep following the client to make sure that they're structured the right way.
Yeah.
Right.
And do you think a situation like you and me, again, restaurant, 50-50, right from the beginning, would you suggest that positioning the policy in the holdcos if we both have holdcos, or do you think we should buy it in the opco?
Really,
Restaurant.
it's a very, very good question. It just depends what's the goal of the policy. So if it's for savings, like there's just so much extra money in the restaurant that you generally don't want to leave a lot of cash in an operating company in case from a liability credit protection perspective. So we try not to leave monies there. So if there's lots of spare money, we'll generally put holdcos above with the ownership for portions of it, and move profits up every year. And then in the holding companies with all that extra money, because the tax rate is so high in a holding company, we tend to use the insurance structure to reduce taxes, right? So it's always a game with taxes. So we prefer to start out of the gate in holding companies.
Mm-hmm.
But generally when people start a restaurant, they don't know.
Yeah.
Right? Their life savings are going into this thing. You remember how hard it was when we opened our restaurant, Sim? Right?
Yes.
so there's not a lot of profit. So you don't generally want to have holding companies because you got to pay for the tax returns.
Yeah.
And at the beginning, everything, is expensive. And entrepreneurs tend to run.
Yeah.
Right? And then
That's
we
what
show up. Then we show up like a decade later and it's a disaster, right? So we have to set up the holding companies and stuff. So, but you want to hold savings assets up in the holding company.
For the creditor proofing as well, like Laura said, I think that's a great point, that you don't want to leave too much money in your operating company. Wonderful. That's a great answer. Thank you so much for sharing that, because a lot of people don't know that.
Well, and you come across somebody who has an operating company, and this happens a lot, and they're like, they've got $2 million of cash there. And I had a client last year, and he had $2 million of cash in his operating company, and one of his drivers had a car accident. There was a lawsuit. Everything was frozen.
So just imagine.
Yeah, so the stress is off the charts. I would have, if he'd had a holding company, that profit would have been up there.
And that was still, so that's something everyone should
we watch.
Yeah.
We watch.
Absolutely. So now another scenario. Okay. We are doing very well right now, right, in our business.
Oh, in our restaurant?
Yeah, restaurant.
Okay.
And now we don't know the future. Okay,
Right.
we don't know the future. What's going to happen? Right now, we've bought the policy. We can afford the policy, but the business, if the business is not doing good,
Right.
and the business cannot afford the premium, what are the options? Because when we started, everything was very good, and some new technology came, something new came, and our business is not doing that well, but we have the liability to pay this premium. So what are the options?
So we actually saw that a fair amount at the beginning of COVID.
Yeah.
A lot of businesses were frozen.
Yeah.
For an extended period of time. Aeronautical, all kinds of businesses just kind of had a heart attack. So the interesting thing about it, if you build these structures correctly, there's a lot of cash in them.
Mm-hmm.
So
permanent policies.
In a permanent policy, there can be a lot of cash. So for example, if someone puts in $100,000 a year, I'm just picking numbers out of this guy.
Yeah.
Generally by the 5th or 6th anniversary, the amount that you've put in is already sitting inside of the policy. So after 5 years of $100,000 a year, there's $500,000
that you can take out while you're alive.
So that's the value.
You don't have
that's
to
the
die.
actual value on the policy, and it's also showing on the balance sheet, right?
Okay.
But it's actually filled with that kind of cash inside of it. It's growing sheltered. So if you hit a bump in the road, there's enough money in there to self-support it.
Mm-hmm.
So
sorry to interrupt you
Yeah,
here.
of
If you
course.
can please explain a little bit more. What do you mean by self-support?
So if we'd made a commitment that we were going to pay $100,000 a year into the policy, and we do it for 5 years or 2 years or whatever the number is, okay?
Yeah.
But I'm using 5 as my example here.
Let's
Okay,
keep it fun.
so we've done it for 5 years, and now all of a sudden nobody's eating Italian food because now it's an Italian restaurant. I'm elevating it to Italian right now. So we're not having any clients, and we don't have the money. We don't have excess profit to put into the structure.
Yeah.
Right. So because there's so much money in it, it'll just pay for itself. It'll just support itself for a very long time.
And this is an inbuilt feature in permanent policies, whole life policies, and this is also called a policy loan.
Yes,
Is it called?
it's a policy. It is a policy loan, or you could take a bank loan if you wanted to. The banks love this asset.
Yeah.
The banks give us 100 cents on the dollar, generally, all the time. Every day, I do it all day long.
Yeah.
So the banks love this asset. They consider it to be equivalent to cash.
Yeah.
Because it is. And it can go on loan, or we can get a loan to support it, or the client can just stop paying.
And make it as a paid up policy?
Yeah, so generally, but it depends. Like if we're just having a rough patch, I probably wouldn't want to do that. But if we're like, this is all the coverage we'll ever need, then we'd have a discussion about, do we need to put any more money into it? Although it just depends on the profitability, what we consider to be the future profitability of our Italian restaurant.
Yeah.
And then we make decisions. It's very, very fluid.
Yeah.
And every business is very different. So that's why we try to build our structures in a way that we have as much choice. We're trying to put the clients in the driver's seat.
Yeah.
Because business is business, right? Like sometimes it's amazing and sometimes it's not.
Sometimes it's not.
So yeah, we have to build that with in mind. Like it's our job to be defensive, right, with the asset class.
So this is so good, like in case they don't have the money to pay, there are the options. They can, whatever the cash is accumulated in the policy, that can be used to pay for the future premiums. Or they can take the policy to the bank, which is to any third party lender, and they can lend it against that, and then that can be paid to the insurance company. Or automatically there is an inbuilt feature that they can take the policy loan from the policy. There are different ways. They can reduce the coverage. They can make it as a paid up policy. Let's say the policy right now is $2 million, and you think that after 5 premiums, $600,000 becomes a paid up. You'll never need to pay. They can do even that option.
Or even to the point, they could just cancel it. Like if we were like, our restaurant is going bankrupt.
Yeah.
And we've put in $500,000 and there's $500,000 cash, and it's within the first 7 years. It's not a taxable event just to make it go away.
So take the money out and you're gone.
No harm, no foul. You had the coverage for the 5 years, and business didn't go the way that we thought business was going to go.
Mm-hmm.
That happens.
Yeah, that does happen,
And then,
of course.
And so be it. It's done.
It's done. And you got money
They
that
got
you
their
paid,
money back.
and the policy is gone.
It's gone.
Yeah,
And
that's
that
an
works
option.
too. It does work.
It does work.
And that's just us being defensive, right? We just want to make sure they're going to be
Yeah, absolutely. So that's called a thorough planning behind the scenes, right? And we really want to do that.
Yeah.
So another scenario, business has many shareholders. Each one of them also have their individual holdco. We did talk about it a little bit already.
Yeah.
Where do we place the policy if the purpose for placing the policy is key man or estate planning or buy sell? So I want you to just look at from that eye and say, what would you suggest?
So key man coverage is generally held in the operating company because we're trying to replace a key person.
Yes.
Right? So that's generally always.
So you and me running a restaurant, there should be key man on you and me both separately.
Yeah, or not. Like say I'm the executive chef, right? So that's not so easily replaceable if that person is a Michelin star or whatever, right? But you could hire another manager.
Yeah.
And that's a conversation for the business owners to have amongst themselves.
So good to have on you because you are the main chef. If you don't cook that well, then there'll be a problem. So okay.
Yeah, like so if you lose the artist of, and some businesses have it, the one person is the rainmaker, or the
Right.
one person has the ability to make a patent, or whatever it is,
Yeah.
right? So that we know that business owners know who's the key man, right?
Absolutely.
And sometimes it's both of them. So for key man, it's generally in the opco, because what happens if something happens to me, if I was to die or something, you'd have to hire another person of that level
Yeah.
to cook, or else nobody's coming to the restaurant and you're bankrupt.
Yeah.
Right? So key man's generally there. If I go to estate planning, generally it's in the holding companies.
Yeah, because that's for the long-term need.
Long-term needs.
Yeah.
All the assets. Like, so when somebody wants to pass away, stuff moves tax-free between spouses, but when you want to go intergenerationally, that's when all the capital gains tax is due on all the assets. So that's estate planning is generally held up in the holding company.
And buy-sell would be again in?
It can be in a bunch of different places.
Okay.
Buy-sell is the most complicated from that aspect. So it depends if the company is ever planning to be sold. Some families it's not.
Yeah.
Right? It's just not. So they hold it in the operating company, because what happens is if someone passes away, this is going to get a little technical, but we're redeeming out share classes and stuff.
Right.
So you do it at the operating company level, or at an insurance company even below that. Depends how many operating companies I've got to work with.
Okay.
Holding company can be interesting. Like my holding company could have a policy on you, because if you pass away, what happens? I need the money to come out of my holding company to buy your shares, so your family gets the capital gains exemption.
Right.
I have to buy your shares, right?
Right.
It has to be directly from the operating company. So it really depends. Buy sell stuff is a lot more complicated. It
Yeah.
depends where the money's going to be. It just depends on a bunch of different things. So we need to sit down. I need an org chart.
Yeah, absolutely.
I need stuff,
We need
because
stuff.
it's not so easy breezy. You want to make sure it's right, because if we put it into place, I want to make sure that past that 7-year break even tax
Yeah.
perspective point, that it's already sitting in the right home.
That's very important. That's very, very
Yeah.
important. And then that's how where you place the policy, and something happens, you have already planned something, the worst that happens in any way. So that is
Yeah.
wonderful. Oh my God, I have so many questions for you, Laura.
I
and
know.
and
I can come back. It's okay.
we need to have you back, because you know what? I see you all the time, but I feel I'm also learning so much. And this podcast is teaching me as well so much, and I'm so happy. I think you got to promise me before we end this that you're going to come back.
I promise. I'll talk to you later today, probably.
No, we have to do another podcast for my viewers.
I promise.
And with that, I thank you so much for coming, my
Pleasure
friend.
was
This
being
was
here.
wonderful. This has been very informative, and I want to give everyone a promise that Laura's coming back.
I will come back. Sim will make me, don't worry.
And that was another episode of the Simple Wealth Wisdom podcast. Please let us know in the comments what you like the most about this podcast. And if there's anything else you want to see or ask, and I'll make sure to bring that to you in our future podcast. Watch for us again next week. Until next time, stay safe. I'm Sim Gakhar. Thank you.